and at the end, we'll go over some questions and answers, and I will stop periodically during the session to do a little bit of question and answer. So I'm going to hit my record button. Okay. Welcome, everyone. I appreciate you being here today. I'm excited about presenting this information and look forward to everyone applying it in whatever way they see fit for their specific account needs. I have a loose agenda to follow today. As I just mentioned before I hit the record button, I will be stopping from time to time and asking questions. Igor is going to be here to try to nudge some questions my way when they pop up. So I look forward to answering all the questions that you have to the best of my ability. I'm in my early 60s. I have a varied financial services background. I will start now just by showing you real quick my LinkedIn page. Okay, are y'all able to see that?
Yep.
Okay, good. So there I am, Notional Ed Kurtz. It's on LinkedIn. I'm not going to dwell on it too long, but you can go here and look at my experience, see my background. I have an insurance, investment, mortgage background, etc. So it is where I get the bulk of my knowledge from. And I'm not a margin expert. I have a brokerage management license that's no longer active, and I was in brokerage management. I managed a couple of day trading rooms in the late 90s, where I did some margin work, but again, it's largely as foreign to me as it is to other people. So I want to pre-qualify that. So check me out on LinkedIn if you want to know who the heck this guy is talking and blabbing away. I'm going to go ahead and go next to, and I have these links up at the top, so you'll be able to see those and copy them for yourselves. We're going to go into what a T-bill is and some various types of government debt, so that you guys can get a decent understanding of that if you don't. So I'm going to read through and scan through some of this, and we'll just go through it. So a Treasury bill is a direct obligation of the U.S. Treasury, which is the U.S. government. It has the shortest maturity. The T-bills go from 4 weeks out to 52 weeks, and that's by definition. And you can see here that there's a 4-week, an 8-week, 13-week, 17, 26, and 52. I tend, and everyone tends to call these a 1 month, 2 month, 3 month, etc., 6 month, 1 year, but they're actually in weeks. So the 4-week is 28 days. It's not really a month. So I'm going to go into that. So by definition, a T-bill is 52 weeks or less. A Treasury note, I'll go down here. A Treasury note is also a government obligated issue, issued by the government, issued by the Treasury, and directly backed by the U.S. government. A Treasury note is 1 year to 10 years, and then a Treasury bond is greater than 10 years out to 30. So those are the differences between a T-bill, a T-note, and a T-bond. It's basically the maturity. The other difference is T-bills are issued at a discount and mature at face value, and that's where your yield comes from. Whereas the Treasury note and Treasury bonds are issued at par generally, which is $100 per 100, and it has a stated coupon rate. We'll get into all that a little more in a few minutes, but I want to go into those basics. This says T-bills can be bought in $100 increments. Typically in our brokerage accounts is $1,000 minimum. Another important thing is this right here. T-bills are subject to federal, but not state and local taxes. So if you're in a state or local municipality, that has income taxes, the states, I cannot speak specifically to all cities. For those of you who might be in a jurisdiction with a city tax, I think it is also tax exempt for you. Please check with your CPA or tax advisor on that and any other tax related things that I may comment on here. What I'm giving is my best knowledge. I can't swear it's always going to be completely tax accurate. So T-bills are not federally taxed, but they are taxed, not state taxed but they are taxed on a federal level. Conversely, if you've heard of municipal bonds, those are issued by states and local municipalities, and those are taxed they are not taxed by the federal government. So, and if you buy, like, let's say you're in, I don't know, we'll make up a state with that I know has a state tax as well, like California. So if you buy a municipal bond in California, it's state tax exempt because it's issued by the state, and it's also federally tax exempt. These are just givens. If you're wondering why, there's a reciprocity agreement between the state and the feds that they're not going to tax each other's debt, and that's where that comes from. All right, I'm going to move on. Oh, here's another interesting point. Yields on T-bills are generally lower than similar investments, such as certificates of deposit. This has not played out in the current rate cycle. In the current rate cycle, for the most part, up until the last few months, Treasury bills have been significantly higher than the rate that banks pay on their CDs. And that is pretty much what led to the big squeeze in March and since then on the banks and their balance sheets, because they kind of got caught in that situation where they were underpaying us for our money. The banks were underpaying us, just like our brokerage accounts were underpaying us. And they did it as long as they could. And, you know, when all that got ripped open with the banking issues that flared in March, banks had to raise their rates pretty substantially to keep deposits in-house. I'll stop there without getting into too much more rabbit hole. So are we clear on what is a bill, what is a note, et cetera? I'm going to get into this competitive and non-competitive business later. We just went into the tax treatment and yields, et cetera. Okay, I'm going to get out of, safety. So safety, let me just touch on that for a minute. So treasuries, you know, we had our big debt scare at the end of May with the government somewhat threatening a default on its 31 or 32 trillion dollars of national debt. I'm not sure of the exact number. Our wonderful politicians played tic-tac-toe with themselves up until the very last second, probably doing nothing else for the most part behind the scenes except messing around with this. And it gave the perception that these investments were risky. And if the government had gone into a default situation, they would not have been able to pay off the interest or the principal of these direct obligations. However, in my opinion, they're not allowed to do that for very long because so much is tied to these rates, both domestically and internationally, the whole system would start getting shredded apart. So they solved that. I consider the risk of default on these as low as anything there is on planet Earth at the moment. So they're safer than bank CDs. They're safer than bank deposits. Why? Because they're direct obligations of the US government. If you have money in XYZ bank, currently with any amount, but typically the FDIC limit is $250,000 per person. I'm just going to talk as if that is the limit. They've expanded it to unlimited after the March banking disaster, but they're going to wind that back down to either 250 or some number when they feel like things have simmered down a little bit. So that is an obligation of FDIC, the Federal Deposit Insurance Corporation, which is an entity of the US government. And the US government is promising to provide that FDIC insurance to the banks who are members of FDIC, who participate in that, which is basically everyone. So are those the same risk? No, they're not the same risk, because the T-bill, T-note, T-bond is a direct obligation of the US government. The CD or bank type CD investment or a bank deposit is FDIC insured, which means it's an indirect government backing. So they're both AAA rated, but one is kind of safer than the other, if you will. All right. The next thing I'm going to go into is some of the pages that I use to do my analysis. My main page is this, or one of my main pages is this treasury.gov. You see this link at the top. And this is the daily Treasury par yield curve rate. So you've probably all heard about the yield curve. We've all been hearing for quite a while that the yield curve is inverted. All right, let's look at what that means. So this particular page, you just select it. It's got different things here. I look at the daily Treasury par yield curve rates. There are different things you can look at. This is what I look at. I have it selected to the current month. You can go back to different years and look at what's going on every day. This I have so this I'm looking at the current month. And it updates at about 2:30 Central every day. So this is since the beginning of September. This is what rates have done across the yield curve. So this is the yield curve from 30 years out to, from 1 month out to 30 years. This is the yield curve in numeric form. Typically, a yield curve starts, if you're looking at my mouse on the right, they start low and they go up. So it's kind of a more rising exponential looking thing. That's a healthy yield curve where short-term rates are lower than long-term rates, just because that's the way it normally is. Typically, you're paid more money for putting your money aside for a longer period than for a shorter period, all things equal. We are not in that environment now because the Fed has been in massive slam on the brakes. Let's get restrictive. Let's stop the loose money thing. And they've gone crazy with it. So that inverts the yield curve, which means these shorter term rates in the 1 month, 2 month, et cetera category are higher than these rates way out in the 10, 20, and 30-year range. So, and this was even more pronounced a few months ago. These long-term rates have been playing catch up the last few months as this higher for longer mantra has built in. These longer rates have kind of edged up as these have remained somewhat flat. Like if we look at the 1 month at the beginning of the month, it was 551. Now it's 552. These rates, even out to 30 in the last week, you see it's up about 8 basis points from 429 to 437. Even then, we have some rise in rates. I could go back further, and this would be more pronounced. This is a function of what can the Fed control with interest rates. So the Fed directly controls the Fed funds rate, which is currently at 5.25% to 5.5%. I'll get into that a little bit more in a minute. And that is what they control normally with the Fed funds rate. Then the Fed in modern times has been more aggressive with things like quantitative tightening and quantitative easing. Quantitative easing is when they buy up existing government obligations in these further out maturities. And that drives these rates down, which enables them to stimulate the economy, not only with their short-term Fed funds interest rate policy, which is what this keys off of, but also by direct manipulation of the longer-term securities by buying them in massive quantity. And I mean like 20 to 50 billion a month or more range is what they were doing for a while. And they're trying to run that off now, but they're doing it. We'll see how that goes. I don't want to go into that rabbit hole too much. So the Fed controls rates mainly on the short end with the Fed funds rate. And then what they're doing with the Fed funds rate makes market participants decide how much they want to earn on these various maturities going out. Okay, I hope that's relatively clear. It's a bit complex. Over time, this stuff will settle in. How do you guys use this page? When you're about to go buy a 1 month T-bill, or roll one over, or if you have a little T-bill ladder that might go from 1 month to 2 months, or some people are doing them now out to 6 months. I've had a few conversations. You can use these, like you can look at, this is yesterday's rate. So if you were participating in an auction that was today, which is the 4 and 8 week, I think closed today and auction Thursday. There are no auctions today. So, but if it were Thursday and you're like, what rate am I going to earn on my 1 month Treasury auction today? You can get an idea of just looking at what yesterday's rate was, this 552, whatever that number is in the 1 month. If you're buying a 1 month on Thursday at the auction, that's what you can expect. You can also use these as a gauge for what you're looking at in the secondary market and not the primary or auction market. We're going to get into that as well. All right. Any questions on this? I'll just stop real quick and ask. Anyone got a question on this stuff? Okay.
So far, no questions in the chat.
All right, Igor, you good with that?
I guess we could just move forward. I mean,
okay. So this next page is the federalreserve.gov. This is just a page basically I have bookmarked so I can see when their meeting calendar is and other things. But this is a meeting of when the Fed meets. So their next meeting is September 19th and 20th. Meeting after that is the end of October, beginning of November, and then one final meeting on December 12th and 13th. The asterisk denotes them meeting with talk afterwards, like when Powell gets on and talks. He typically has one of these. They always make their rate decision on the second day. That's the other thing. So there's a 2-day meeting, but they have their announcement on the second day. And you can look back on when meetings were. Like here, the meetings in 2022, and you can pull up all kind of crazy stuff like past minutes and the press conference. It's just a ton of data here. I mainly use it to see what the heck, when is the next meeting? And I'm kind of a more advanced T-bill ladder builder, so I'll try to build my maturities around some of these dates so that I have my money coming up right before, right after, so I can make a decision on that. Okay, another page I have, which you may or may not hear sometime in the financial press. This is from the CME. This is based on market participation, and it is a Fed Watch tool. And what they are doing is on given maturities, you see, we can look at September, and then we can look and see what the odds are for the September meeting, which is 2 weeks from now. There's a 93% chance that the Fed funds rate will remain in the 5.25 to 5.5 range. There's a 7% chance they will raise rates at that meeting. So very, very low chance rates are getting bumped in September. 93% chance they won't. If you look in November, and this is based on market bets, market participation on where the market is pricing Fed funds futures and bond yields and that type of thing. So if we look into November for the October 31st, November 1st announcement date, it's a bit tighter on what they're going to do. It's a 56% chance that they'll leave rates where they are, and there's a 41% chance they're going to raise it a quarter. See, it says 5.25 to 5.5. 41% chance they're going to raise it to 5.5 to 5.75. And then a microscopic chance of about 3% that they might bump it to 5.75 to 6, that would be insane, but hey, who knows? And then as you see, there's all kind of dates at the top. So over time, you can click on these different months and see, well, what's the odds of in December that there's at least a 0.5 point increase? Well, then it's still the same 50-something and 40-something. It hasn't changed. This hasn't really much changed. So the odds are pretty much the same in November and December that the Fed may or may not hike again. There's a slightly higher chance that they will, but there's an almost equal chance, give or take, that they won't. And then they're data dependent. That means they're watching all these economic numbers and what's going on there. And what I've seen there personally is a lot of warm to hot numbers in the employment and the inflation numbers. They haven't really cooled off a lot. The headline inflation numbers down, the under the surface that includes food and energy is actually pretty resilient. And for those of you that trade crude and the commodities, you can kind of see sugar hit I think a 27-year high or something earlier today. Commodities are kind of putting upward pressure on inflation. Blah, blah, blah. I'll stop there. Here's an economic page I look at, tradingeconomics.com. It shows things for all over the world. I tend to just look at the US. This is for tomorrow morning. Tomorrow morning, we have the big inflation rate for the month over month. This is a big one. Everyone gets all nervous about it, the CPI, da-da-da. And look, you can look at gas, the gas and crude inventory information. This is a pretty handy site for tracking things like this if you want to at all. This page, it's the St. Louis Fed. It basically shows the effective rate of what is the Fed funds rate. It's as of September 1st, which is still accurate. You see this 5.33, that's the average of this, the 5.25 to 5.5, more or less averages to this 5.33. which means it's not 5.25 and it's not 5.5. It's somewhere a hybrid rate. This is a historical rate of where the Fed funds rate has been all the way back to 1955. You can see we had this huge inflation problem in the 70s. The Fed tried to fight it here. They quit too early and inflation surged again, forcing them to jack rates. I don't know who was alive back then to remember, but Paul Volcker was brought in as the Federal Reserve Chairman. He jacked rates up. The Fed funds rate went to somewhere around 20-ish%. I can't tell you exactly, but you can see way up here, it's at 19.1. So it's somewhere up around there. And then we've kind of been in a 30-year rate decline period. And then we went through the whole post-Great Recession, 2008, 2009, when the Fed got very aggressive. The economic world was completely coming unwound. They jammed rates to zero and left them there for the better part of a half to full generation, where bad things happened and good things happened. Bad things happened for those that were saving money because whatever they were earning on their fixed income and other things went to zero. So you have a whole segment of the older population. Many of you probably have parents who have been digging through their savings for years and years up until recently because they weren't earning anything on their portfolio. So for everyone that went into 2010 with, say, $1 million or $2 million earning fixed income, within a very short period of time, all that stuff matured or was called, and they were forced to earn zero. So a lot of people ended up earning zero, and instead of spending the interest on their savings, they actually spent their savings. So those were the people that were hurt by a zero interest rate policy, as well as their descendants. So if some of you have parents that were once wealthy and now aren't because rates were so low for so long, they had to blow through all their money. Your parents were penalized, and now you are penalized because you are not going to get the inheritance that you once would have. The government policy has penalized savers for a long time with the zero interest rate policy. They have rewarded debtors or borrowers by jamming rates low. So I, among many others, feasted on super low mortgage rates. If not during this initial low period, certainly we had another chance out here post-COVID when rates were squished down to like stupid low. You could get a 30-year mortgage for under 3%. A lot of people have. That's creating a housing problem now. I won't go into that, but we could certainly talk about it into the future. So I'm going to stop there and ask, do we have any questions? I just admitted some people to the waiting room. Okay. All right. All right. Igor, you haven't nudged me yet, but I'm going to warn you. Give me a nudge, buddy, because I will ramble. All right. Let's go into the next thing. And that is the how-to. How do we participate in this T-bill? And then I'm going to get into the T-bill ETFs, but let's go the T-bills first. So there are two ways to participate in T-bills. You can do it through the primary market, which is the auction market, or you can do it in the secondary market. This particular site shows the primary market and upcoming auctions. This is treasurydirect.gov. You can go to treasurydirect.gov and buy your treasury securities there directly, but you don't want to do that if you have a brokerage account, because our goal is to put our unused cash to work into these fixed income vehicles, our excess cash, so that we can earn a return on those versus the zero return we were getting before. And I'll dwell on that a little more, but the objective is not to jam every penny we can into T-bills and T-bill ETFs. It's to determine how much extra cash we actually have in our trading accounts and utilize that without obtaining a margin loan. If we use more than the cash in our account, we generate a margin loan. By putting our money into these treasury type investments, either the T-bills, which are direct treasury obligation, or the T-bill ETFs, which are made up of treasury obligations, we are, excuse me just a second. we're maximizing our cash return on our entire portfolio. We don't want to use more. We don't want a bigger allocation into these things than we have cash available, because when you do, you're earning the 5% plus on your fixed income investment. But if you end up borrowing cash, you're going to pay a double-digit rate of return unless you're at IBKR. I don't know what their rate is. They're very consumer friendly. It's probably something in the 8% range. Every other name brand broker is charging 12, 13, 15%. So you're going to be earning 5% on the investment and paying 12 to 15% on the loan, on the part that you've done a loan on. You do not want a margin loan. We do not want to pay margin interest for any longer than we have to. If we push this and we have a slight over allocation, back off, or we do a trade or two, we see we have some margin interest accumulating, we need to liquefy and get more cash. I'm going to get into the strategy part of that in a little bit. Back to this. This announces when auctions are upcoming. So we have upcoming auctions. Under this same page, we have auction results. These are auctions that took place recently. These are the issue dates of these. We're going to go into some of these details. Upcoming auctions, which is this week. So today's the 12th. So here's the 17-week. Ameritrade does not do the 17-week. They do the 4-week, 8-week, and 13 and 26-week. For whatever reason, they don't like the 17-week. I don't know what the reason is, but they don't. So if you're with them, you can't do that. If you're somewhere else, they may allow it. I'm not sure who does offer that. But moving away from that, the 4 and 8-week T-bill auction was announced today. The auction date is 2 days from now, which is Thursday. And then the issue date is a week from the auction date for the 4 and the 8-week. So if you wanted to participate in the 4 or 8-week, you put your order in starting today up until Thursday, but your broker has to open the window Thursday morning. Otherwise, you see people maybe saying, oh, it's T-bill Tuesday. That's for the 4 and 8-week. That's because that's when these auctions open up. You can start putting your order in then. This is when the auction actually takes place. This is when it actually settles. And you start earning interest. You don't earn interest on the auction date. You earn interest on the issue date. And then you have your 3-month and 6-month or 13 and 26-week. Those start, they open on Thursday. They close Monday morning. And the auction is Monday morning. So the best thing to do is if you see an auction date of the 14th, get your order in between the 12th and 13th. And I'm going to go through the mechanics of how to do that at a couple of different brokers in a minute. All right, I'm going to stop here and ask questions. I see there might be one. I put an order in for an 8-week today on TDA. Okay, Bruce, great. So Bruce, your order that you placed today, it will get auctioned on Thursday. The auction will take place. You can see what your rate is on this page. So once the auction happens, and they typically happen later in the morning, mid to late morning, your upcoming auction will become an auction that has taken place. So last week's auction, let's just use the 4-week. This is the details of how this auction went. So every security has a CUSIP. See this word right here, CUSIP? I don't know what CUSIP stands for, but it's an electronic tag for everything. Every stock, every treasury. I think options have it. I think futures have it, although I can't swear to that, but I'm almost positive that they do. Everything has a CUSIP. It's an electronic identifier that back office of all these places use to process. So the CUSIP, I'm going to click on this. We're going to go into it. That wasn't very smooth. Let me try that again. Okay. So my apologies. I clicked on the CUSIP. I actually should have clicked on the name itself. This gives us different info that we can download into a spreadsheet, etc. So now we're looking at the 4-week that auctioned last Tuesday. I mean, that auctioned actually, it issued, you entered your order last Tuesday and Wednesday. It auctioned Thursday, and it actually was issued today. So here are the details of that specific auction. The auction issue was today. The maturity date is October 10th. The treasury bill, if you remember at the beginning, was a security that is auctioned at a discount and matures for face value. So I've just highlighted the price. This is the price that the 4-week settled at, 99.589. It's going to grow to be $100. So you buy it for $99.59, we'll call it today, $99.59. It's actually 58.9333 cents. And it matures on October 10th for full face value. Now, that doesn't look like much, but that annualizes out at a 5.28 rate. Now, I'm going to go into a little bit of detail here on how this works. So over here, we looked at some things, and we went into this competitive and non-competitive bidding thing. And I said I'm going to touch on that later. Well, now's later. So this auction that took place last week and the T-bill that was issued today had two components, a competitive and a non-competitive component. We enter our orders as non-competitive bidders. There is a limit to the amount that you can buy at an auction. So if you're a gigantic hedge fund, family office, or entity like a mutual fund or a brokerage company or whatever, you have to go in at the competitive rate because you have to actually bid what you want your rate to be. We are given the non-competitive rate, which, by the way, is automatically the highest rate that is produced at the auction. Now, what does that mean? It means these competitive bidders, these big shots that we just mentioned, are in there figuring out what rate do I want to earn and what rate do I think I'm going to get. They can't go, they can look at this same sheet that I said, oh, look at this. You want to do the 4-week, look at what it was yesterday. They can go in at 552 if they want to. Now, this was last week's auction, but just bear with me there. They can go on 552, the 5.52 rate. They may or may not get it. So this, because it's high, they need to underbid their rate. So they expect a lower rate of return. So they have a chance of getting their order filled versus all the other competitive bidding that's going on. So all those big shots are fighting it out with their auction pricing, and they're battling each other out, having their little price war. The thing settles, and it settles when like the cutoff comes and all these guys and gals are through putting their giant orders in, and it settles. And then we get the report. So the report says the low rate right here was 520. So the lowest anyone bid and got a piece of was 520. The highest rate that anyone bid and got a piece of was 528. So we automatically get the highest rate. We automatically get 8 basis points, 5.28 instead of 5.20. We get 5.28. We get the highest rate. This median rate is just the median rate. It's not the average rate. A median rate is the rate. If you take all your numbers and you line them up in 1,000 numbers, you take the 500th number or 501st number, that's the median rate. It's just the center rate. This is it, 526. Okay. So we get the 528. Because we're buying it at a discount to par, T-bills are issued at a discount and they grow to be $100 per $100 of value. So if you buy $1,000 worth, you're going to pay $995.89, and it will grow to be $1,000. So you're going to earn about 41 bucks over the course of the month. We'll get into the numbers. They seem laughable, but when you multiply over time and you really look at your account values, The bigger your account value, the more this has serious relevance for you. So at any rate, the rate is the rate of discount off of that $100 or par. So they're discounting the 100 maturity value by 5.28%. They come up with 99.58 cents per 100. And that gives you an investment rate of 5.39%. The 5.39% is what your 99.58 cents grows into 100. That is at a 5.39% rate. If you remember your math, when you discount something by a certain percentage, it has to increase by more than that percentage to get back to where it was. That's what's going on here. These are how much the T-bill is discounted by. This is the actual rate of return. It's your investment rate. So to clarify again, you go into this treasurydirect.gov, you look for the auction results. Anyone who participated in today's auction or last week's auction, it was issued today, and this is the rate and details of what you earned. You just click on that page and you get it. I've seen some people print these out. It's not a horrible thing to have. It just depends on how you want to work it. And you can look back and see what's happened at all kind of different things. So there's that. And then you can also look at different upcoming auctions. We have the 4-week, 8-week, 13-week, and 26-week. The 4 and 8 are at the beginning of the week. The 13 and the 26 are at the end of the week, and they actually go into Monday where the auction happens, and then they're issued on the 21st, which is, I think, next Thursday. If they're more available, like the 1 year and the 2 year, those are auctioned one time per month. These are weekly. All these are weekly. Every week this stuff happens. The 2 week, the 2 year, 3 year, et cetera, those have different offering schedules. Okay, I'll stop there. Let's see if we have any questions. I don't see any in chat. Okay, let's go into the how do I do this. So I'm going to go into a couple of different brokerage accounts and just show you how it works. For those that are at, and I have an Ameritrade, I have Schwab, and I have Tasty. I do not have an IBKR account. I don't have accounts elsewhere. There's some variance between each one of these. Ameritrade and Schwab both offer primary auction access, which is what we've been discussing here, where you go to the broker, you enter your order on those certain days, and then they have a secondary market. Tasty only has a secondary market. IBKR only has a secondary market. And there's different price competitiveness at those different ones. So I have seen where IBKR has good pricing in the secondary market. Schwab has good pricing in the secondary market. Fidelity has good secondary market quotes. Ameritrade's is not as good. It's usually about 8 to 10 basis points lower. So if you're doing 1,000 or 2, it doesn't really matter. When you're doing bigger pieces, it does. I'm doing bigger pieces in my big account. I tend to do $50,000 T-bills. And at Ameritrade, it was costing me $80 to $100 more to do it there than at Schwab. So I moved the bulk of my money to Schwab, where I can get the better pricing on every T-bill roll or new initiation that I do in the secondary market. The primary market, it is what it is. There's no worrying about anything. There's no commission. There's no nothing. So you go off at auction and you get your money. I'm going to go in now and just show you how to do some of this stuff. So here, and I'm going to go into my Thinkorswim platform as well on this, but I want to show you how to first. This is an account that I had. This was my main account at Thinkorswim. I moved all the money to Schwab, and then I'm repapering and moving money back to Ameritrade. I do not suggest anybody move their money ahead of time, ahead of when you're being told to move it to Schwab, because there's some negative ramifications for doing so. One is if you leave your Ameritrade account and move all your money to Schwab, they're going to close your Ameritrade account and all your past records are going to be locked up. If you leave your account open, then all that information will flow to Schwab and you'll have at least 7 years of back data to capture. So don't do it ahead of time. And if you do want to move it for reasons like I did, if you do a big amount of treasuries and you have some, like I was going to do about 8 to 9 treasuries between now and March. And I was going to be paying Ameritrade like $1,100 extra dollars. Well, I'm just not doing that. So if you have a good reason for doing it, do it. I'm moving money back. So this account will move over on the regular timetable. I'm slated for March of 2024. Okay. Let's go in and see how to do these actual trades. So there's a few ways to get to this section. I like going to trade, bonds and CDs. While I'm doing this, by the way, you have got to go into the website. This cannot be done on the Thinkorswim platform. It cannot be done on Schwab's platform, either of any of them. You have to go into the web to do it. So we're going into the web. We went to trade, bonds and CDs. It gives us all these options. We want to do treasuries. So you can just click right here. Any of them will do. It brings you to this page. This is the secondary market for treasuries. I'm going to cover that in a minute. Let's go into this new issues section first. Okay. So we went to trade. We went to bonds and CDs. It pulled up that other thing. I clicked on that little treasury button and it brought me to this where I clicked on new issues. And now I want to look at treasury auctions. I'm just going to look at all of them. You can look at your specific time frame. I like to look and see what's available on all. As we mentioned, the 4 and the 8 week are open for orders right now. It was announced on the 12th. It closes early Thursday morning. The auction goes off Thursday morning on the 14th, and the securities settle on the 19th. That's when they take the money out. Side note, if you have money in your Ameritrade or Schwab or whatever account, and you do an auction, they may very well take that money out of your account right then and there. You're not earning interest on it, but they're very possibly going to yank your money out right then and there. I've seen it happen on my account quite often. So if you want to participate in the 4 week auction, because a lot of people are just doing 4 week and every time they just roll the 4 week, 4 week, 4 week, 4 week. That's great. You just click the button, you go down here and you tell it how many you want to buy. You have to do a minimum of 1 and a maximum of who knows, and that's in thousands. So this is 1,000. I'll just leave it there. You then click review order. And it tells you the auction date is the 12th. This is the CUSIP that you're buying. The auction closes on the 14th. You're looking to buy $1,000. It matures on October 17th. Blah, 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 blah. And then you just click place order. And it sends it in. Okay, I could do that, but I don't want to place an order. Any questions on that? You guys are very quiet. I'm not used to this. Okay, maybe you're just saving yourselves. So that's the primary market, new issue treasury auctions. You go in, I'll just run through it real quickly. Trade, bonds and CDs, treasuries. You click on any of these to get there. We'll just click on that one. This brings up secondary market. You go to new issues. You always want to go to treasuries. We're only dealing with treasuries here. I'm not messing with corporates. I'm not messing with munis. I'm not even messing with government agency bonds. There's really no need. We get nice, fat, juicy yields right off the treasuries themselves. So you can click on any of those. If a circle is there, the auction is open. So you see 4 week, 8 week, nothing in all these. And oops, look here, the 30 years open. 30 years open for business. So the auction date is tomorrow. It was announced on the 7th. So you're rapidly entering the last few hours of availability to enter that 30-year auction. Not that anyone wants it unless they just won the lotto last night and they got $1 gazillion to lock up at 4 point something. Don't click that button. So you have that. Then you have the secondary market. So this is where you buy the button according to these time dates. You wait for the auction to happen like we discussed over here. The auction goes off on whatever date you think. Then you can click on the maturity of the auction that you are buying.
Hey, Ed, I have a question. Is there any way to see the yield on the TD Ameritrade website?
Over here.
Yeah.
No, because they don't know what the rate's going to be until the auction happens.
Mhm.
So we're entering our orders today on the 12th, but the auction doesn't happen till the 14th. So let's say the Fed comes out tomorrow with the government announces the CPI tomorrow, and instead of it coming in at, I don't know what the number is, 3.2%. Oops, it comes in at 5 or 5.5. It's a scorching hot number. This rate's going to shoot through the roof because they're going to automatically price in that there is going to be a Fed hike in September and maybe another one in November, that type of thing. So
Right. So demand
will
will fall and that'll cause yield to rise.
Yes. Yeah.
Got it.
People will be spooked by what's happened,
Mhm.
and it'll cause the rate to rise. Conversely, we might come in at a 1% rate and people panic the other way and like, oh my God, they're definitely not going to raise. There's not a 50% chance or more that they're going to hike in the next 2 or 3 meetings. In fact, we're going to price in them cutting by the end of the year, which is not factored in right now until next summer is when they're estimating rates will start falling. So market perception changes a lot of these rate dynamics. And it's that market perception. Well, I'm going to go back to this yield curve page. The Fed controls the Fed funds rate. The 1 month keys off that Fed funds rate and the expectations of what's coming in the future. So right now, the effective Fed funds rate is 5.33. If you guys remember that from this page over here, it's 5.33. The price of the 4-week or 1 month is actually 5.52. So they're already pricing in about 20 basis points of potential Fed hike while this 1 month T-bill lives. So there's a little bit of pricing into that. If something happened, we had a super soft CPI number tomorrow, this could drop to 5%. The Fed funds could be 5.3, but this rate drops to 5 because the market's now betting heavily that the Fed's going to start cutting soon. I hope that makes sense. Did that answer your question? Okay.
Yes, it definitely makes sense. Thank
And
you.
guys and gals, a lot of this stuff, you can't just listen to this and finish the seminar and know it all. It'd be like me presenting options or me presenting like how do stocks work. You might get some of it, but you're going to need some repetition, practice, and patience with yourself. So this is foreign verbiage for most of you. No one practically has been exposed to that. Igor and I had a brief conversation before the session. He said he's had modest exposure to this despite his extensive background on Wall Street. And I don't know how old Igor is, but I'm sure he's younger than I am. But I'm in my early 60s. Most people, even my age, I mean, the last time rates were where they are now was way back in the 2000s, the early to mid 2000s, like before all the hell broke loose. And that's a long time ago for most people. So unless you had accumulated some savings and you had money in fixed income already going into that period, there is at least a generation or so that has had no exposure to any of this stuff. So it's very foreign. So a lot of what I'm presenting is not familiar. And just like the first time you heard about a put or a call or buying them, selling them and spreads and all this other business, you're like, oh my God, I got a headache, but I love it. This is the same thing. It's going to take some knowledge acquisition and time to let it sink in. And this is all sidebar commentary, but I'm in the room. I'm available in the room. You can message me there. You can message me kind of anywhere, and I'll see your little red dot go up, and I'll do my best to get to you as quickly as possible to answer whatever questions you may have. I also fully realize that there are probably a few of you with some questions out there, and you're just scared to ask a question because you don't want your question to seem too stupid in front of the crowd, and I understand and respect that. So, oh, look at you, Igor, admitting your age there in the chat room. Thank you, buddy. Okay, let's see. Okay, so there's someone who's saying I buy auction at TDA and I only get charged 2 days after the auction. So the auction goes off. They do take the money out the day of the auction. I'm not sure exactly what this person's saying, but when the auction of the 4-week happens on the 14th. They will sometimes, they've taken the money out of my account. They will absolutely take it out on the settlement date of the 19th, which is next Tuesday. Okay, let's see here. I can go into more details. This primary, secondary market business, I'm sure there's some people that are like, yeah, I know that. I've been doing that already. There are probably some more people like, I've never seen it before. I don't know what the heck this guy's talking about. Again, you'll have this seminar to refer back to, and you'll have me to ask questions of. And a lot of people are very savvy in the fixed income room. So, ask your questions and answers will be given. Just remember, you have two means of acquiring these things: at auction and the secondary market. So go back to the secondary market for just a minute. Come on, internet. All right, in the secondary market, like this stuff starts out, like the nearest maturity is 3 days from now. Now, who would want to buy that? I have no idea. But you can go out here and in your brokerage accounts, where like at IBKR and Tasty, you don't have this list to choose from at Tasty. At Tasty, you have to get the QSIP, this QSIP number I was mentioning, and give them the QSIP. You call them, you say, I want to buy X amount of this T-bill. They put you on hold. They go get a price. They call Apex, their clearing broker. Apex calls whoever they call, because Apex probably doesn't have the bonds in inventory themselves. They buy the security. They market, Apex marks it up, and then Tasty may mark it up again and then charge you a $25 commission. Extremely unfriendly toward consumers in the T-bill market. That's an area where we get into the T-bill ETF, because it's a click of a button in and out, but there's some benefits and disadvantages of that, which we'll get into as well. So this is the secondary market. You would basically skim through these, and you can modify your search. You can refine a search and go in here and tell it how many years you want it to be and what kind of minimum coupon you want, what type of securities, and then click refine search. It'll narrow this down somewhat, but you can go out a month. If you didn't have primary access and you only had secondary access, like at IBKR, they list their secondary market securities and you can buy them right there on the platform. You don't have to talk to a person. You can look out there and see what they have offered. It doesn't look like this, but it looks like it's on their platform. It's a page, you'll see it. But there are all these different maturities right here that you can pick. And these are all the different rates for those securities. These are all the yield to maturity. I'm not going to go into this. This is yield to worst. Most of these things are not callable. If something was callable, the yield to worst would be the worst of the yield to call versus yield to maturity. I don't want to go there too much. I know that's like Latin, so we'll just stop there. This is the secondary market at Thinkorswim, Ameritrade. I'll go in here and show you the secondary market as well as my apparent account number there. So congrats, y'all get to see my account number and balances. This is their secondary market. They also have primary market access, but you can buy it right in the secondary market. So if you want to buy a 3-month, you can just click right here. If you want to buy a 6-month, 1 year, let's just look at the 3-month. These are all the securities that they have in that 3-month category. And you can just go in and pick one of these. You can see when they mature right here. You can see what the various yields to maturity are. And these are the prices that you pay. Again, these are T-bills for the most part. These with rates are Treasury notes. We'll click on one of those in a second. All these bills are bought at a discount. So all these prices up to here are at a discount. 98 point something, 98 point something. But you buy it at a discount, it matures for 100. That's your rate of return. That's the return you earn. And this is the amount that it is. Very similar to buy here. You just go in, click buy. All right. If we want to blame someone for this connection, it's AT&T.
So while that's loading, we have a question. Does TDA charge fees to buy T-bills?
Good question. So they do not, no one charges an auction commission that I'm aware of. In the secondary market, it's a little complicated because as I just blew through, when you're dealing with someone who does not have T-bills in inventory, I don't know what happened there. When you have T-bills that are not in inventory, they have to go get those. So when Schwab has Schwab Bank may have these T-bills in their inventory. If they do, that might be one of the reasons we get better money there versus elsewhere. If they do not, they have to go out. Like Tasty will go to Apex, their clearing firm, and they say, hey, I have a customer who wants blah, blah, this QSIP. And then they buy it and they mark it up. So if they bought it at 99.5 cents, they might mark it up to 99.55 cents and charge you a nickel per bond, a nickel per $100, for instance. So if you buy a $10,000 piece, I've been charged a couple of bucks at Ameritrade. Typically, though, they can mark up the price, which means bump the price up, meaning you pay a higher price, meaning they make a little piece of money off of buying it and then reselling it to you. Kind of almost like a market maker, if you're familiar with that and how it works. And when you go to sell in the secondary market, they charge. I've only had to sell one time at Ameritrade. I sold a $15,000 piece and they charged me $2 to do it. So it's not a big charge. It's very minimal compared to the benefit you're getting, except at Tasty, who charges a $25 fee. So T-bills are not very friendly at Tasty. Okay, let's see. Yes, the Ameritrade page can be very glitchy. It can sometimes, this page sometimes doesn't even come up. It's Java. So if that means something to you guys, it means sometimes this page goes funky. It's either blank or it says blah, blah. You just have to hit the refresh button and hope. It's very antiquated. Let's see what these other questions are. Okay, is there a period of time that your dollars sit idle between auctions? If you roll a 4-week auction, for example. Okay, great question. So let's go back here and look at this. So if you have a treasury that matures, let's say you're doing 4 weeks and the auction takes place on Thursday. So the one you bought 4 weeks ago is maturing day after tomorrow. You can place your order today. I'm sorry, it's issued next Tuesday. You place your order today, the auction takes place on the 14th. There's no money in there because the money's still sitting in your maturing T-bill, which matures on the 19th. When it matures on the 19th, the money matures and goes into your account and immediately goes to settle this 4-week treasury that you bought. So if you have a treasury that's maturing, a T-bill that's maturing next Tuesday, you can enter the order today for Thursday's auction that settles next Tuesday, and it settles with the money from your maturing T-bill, which enables you to not lose 1 minute of interest. Okay.
Ed, are you saying the maturity date equals to the issue date, and that's how they roll from one to the other?
Yes. When you enter your order a week in advance, today or tomorrow for Thursday's auction that settles next Tuesday, your maturing T-bill next Tuesday is filled with the maturing proceeds of that existing T-bill.
Perfect.
So does that make sense?
Yep.
They kind of overlap. As long as you have a maturing T-bill that matures the same day as the issue date of your new T-bill, they will fill each other. Okay. Let's glance through some of this.
And in order to align, right, the maturity date with the issuance date, they have to be on the same bill, like a 4-week to 4-week, or can you go from 4-week to 8-week?
Also a great question, Igor, because you could have a 4-week that matures next Tuesday.
Mm-hmm.
And you could also have, and you could be buying the 8-week. You might say, well, I don't want the 4-week anymore. I'm going to stretch it out a little and go an 8-week. You can enter that order today. It auctions Thursday and it fills on, it issues next Tuesday, and that would be covered with your maturing proceeds from your prior 4-week. I hope that made sense.
Yes, it does.
All right.
Thank you.
I'm an hour in. I have not covered everything I want to cover, but I have covered the basics. So if it's okay, I'm going to stop the recording now. We're going to take a short question and answer period. And then I'm going to go into some advanced stuff like how margin works on all this. So I'm going to go ahead and stop the recording for a minute. Okay. So I stopped mine. I don't know if anyone else, Igor, are you still recording? You free to keep recording. I don't know if you want a super long one or not.
Yeah, that's fine.
All right. Because I see this question by Jay. I see how it helps T margin, reg T margin. I guess that's what you're saying. Reg T margin accounts, blah, 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 blah. We're going to get into all that in the next section. I did not want to go there here. I do want to just give everyone a chance. I know I've thrown like a day's worth of information into the last hour. I'm sorry. I don't know how else to condense this stuff. This, frankly, is the shortest I've ever done it. And I just wanted to stop to see what questions someone may have, and then we'll dive back into how this works. Any hands up? Any questions? Nope. Okay. Then I'm going to go back in.
Let's do it.
All right. Okay. Welcome back, everyone. We're back in the session. We're going to do more information on details, and we're going to cover now like different types of account and how margin more or less generally reacts in those types of accounts, and how it varies by broker. And I'm going to give you this information to the best of my ability. As I mentioned before, I'm not a margin specialist. I'm not an ex-brokerage employee where I did this stuff all day, every day. I am not that. So largely my experience has been gained through my actual practice and what I've studied and learned up on in the last few months. I've done a zillion calls to these brokers to try to get the actual what with how it works. And that's been a challenge in and of itself. So now I'd like to go into a little detail on the different types of accounts there are and the different abilities we have to operate in those different accounts. So the first type we have is what almost everyone has, is a Reg T account. People with larger balances have a portfolio margin account. And for those of you that have one or are familiar with it, you know that the portfolio margin account is a higher leverage ability than a Reg T account. And in an IRA account, you have no leverage in that you can't use, there's no cash relief on your T-bill and your T-bill ETF purchases. They use the amount of cash they use, and there is no buying power relief for them in an IRA, a 401k, or any other qualified plan that you may be using. Portfolio management works very much like span margin for futures. So if you're trading index and equity options in a span margin account, either like on individual stocks, the NDX, the SPX, etc. And I'm thinking the most likely use is SPX. there. It's not a future, it's an index, but it's still a 1256 contract like your futures. And you still have that span margin like effect where you only put up a tiny amount of the potential notional risk. And then you have to have cash set aside or buying power set aside for you to absorb the margin wiggles from account volatility. When VIX spikes or the market plunges or whatever, you need available cash or buying power for that. I'm going to cover no futures first, which I know is not what most of you guys are doing, but it's a great foundation to start with. So in a portfolio margin account, first in a Reg T account where you just have regular margin, let's say you have 100,000 in there, you have some margin relief when you buy the Treasury bill, both in a Reg T and a portfolio margin account. Typically, and Ameritrade is the friendliest. Ameritrade on a 1 year or less T-bill does 1%. So if you buy $100,000 worth of T-bills, they release $99,000 worth of buying power for you to use for your option trades for equity index options and equity and index options, and the buying power that they need and the margin expansion that they need. So you don't really need much cash at all if you're not trading futures. That being said, I want to stop here and say, number one, you cannot use your cash more than once. So you can't buy $99,000 worth of T-bills in a $100,000 portfolio margin or a Reg T account, get $99,000 worth of relief or buying power freed up, and then go buy another $99,000 worth of T-bills. You cannot do that. You can only use your cash one time. If you use your cash more than one time, you're going to incur a margin loan. That's the simple headline. There's a lot of nuance below that. For anyone that's been in the fixed income room or paying any attention to this, you've seen like the almost chaos that it can produce at times, but it can be navigated through. We just have to be patient and not overload our accounts, because that's when we get margin interest and maybe a potentially large amount of margin interest, and we do not want that. So rule number one is you can't use more cash than you have showing in your account. So if you have a $100,000 account, you're not trading futures, you probably can buy $99,000 worth of treasuries and use all that buying power for your securities. I'm going to show you. Let me just show you my account real quick. So in this account, I'm running, so there's my balance. In this account, I'm running a real thick 2-year T-bill ladder and a SPY put campaign. This is the SPY leap. I'm doing that. I'll explain that, but not today. I've explained it in the fixed income room. I'm happy to talk about it more. But I'm doing a SPY leap campaign. I also do a little bit of XLU. I've dabbled in Microsoft and Apple on that, but I'm not quite there yet, so it's all good. Then I have my fixed income. So I have all these T-bills that go out all the way into August of 2025. My soonest one maturing is this September. So in 16 days, I'll have that one mature. I have some more maturing this year. Why am I laddering? Well, when I first started doing this a year ago, I had everything in the 1 month. And then as the Fed was raising rates, the longer maturities were actually paying more. So at first, this rate was the highest, but over time, these rates started rising up. So as these rates rose and became even higher, I extended my ladder from 1 month to 1 month, 2 month, and then I went out to 6 months. So on a 2-month treasury ladder, you buy a 1 month and a 2 month. And then a month from now, your 1 month is maturing and your 2-month T-bill has become a 1-month T-bill. And you use your maturing T-bill from the original 1 month to go out and buy a 2-month. So every month you're going to have a T-bill that matures, and every month you go out and buy a new T-bill in a 2-month maturity. And at that moment, you have a 1 month and a 2-month T-bill in your portfolio. That is a 2-month T-bill ladder. Doing the same thing out to 6 months, you would do the same thing. You just slowly, or you could buy them all. And then when the 1 month matures, you go out and buy a 6 month. When the next 1 month matures, you go out and buy a 6 month, 6 month, 6 month. Well, this year, as rates have risen and are not at, but I think approaching a near-term cyclical top, I have extended my ladder out so that I can lock in these rates for a longer period of time. Like today, the 2-year is back above 2% again. I mean, 5%. A week or so ago, it popped above 5%, and I reached out and got a 2-year maturity. That's where this thing came from that I just showed you, or I bought it in the open market. I can't remember which. Okay. But that's what I did there, because I'm going out because I want to earn this 5% as long as I possibly can. So the only way for me to do that is to go out, because when the Fed starts cutting rates next year, the short-term rates are going to plunge. And the yield curve will uninvert, and these short-term rates will probably be lower than the long-term rates. So because I'm buying T-bills in massive amounts, and I'm running a SPY campaign off of the buying power, not the right page. All right, this is at Schwab. I'm going to show you something a little confusing. I have a balance subject to margin right now. This is because I sold some BIL last week because I wanted to move the money into my Ameritrade account, which is this one, which is at 50. So I did it. I sold it Friday. I wrote a check Friday. I deposited it virtually Friday, and they put the money in my account Friday. The check did not get presented for cashing until yesterday, according to Schwab. So this is my net amount of interest, that is a balance that's subject to interest. For 1 day, I'm paying $17.58. Why did I do that? Because I wanted to get the money over in this account today to potentially show it to you guys, to show you what I've done with it. So we'll hopefully get into that in a minute. I also bought BIL last Friday with it. So although I was paying some margin interest for a day, I also, well, I bought this bill last Friday. So it's been earning that 5 point whatever percent since last Friday. So it kind of offsets the balance. All right. I hope that has a little meaning for you guys. That's what's going on there. At Schwab, you can pull this page up and it tells you this is your balance subject to interest. This is how much interest you're paying. This is not normal at Tasty. It's a nightmare. My point of showing this to you is I have very little. So I have 17,000 in cash right now. Last week, that's mostly from the options premium that I've sold. I also have a little bit of cash left from the BIL I sold that didn't get moved. I have margin excess. You see this portfolio margin excess? That's how much I can use of buying power, selling SPY puts, SPX trades, individual stock equities, anything but futures that's got an option. I can use all that buying power and none of the cash to do it. So in this account, as you guys saw a minute ago, it's a $700,000 account. I have $681,000, 676 of total value of the T-bills. I have, this is my premium total, and then I have some bill, which is still worth $6,400. So you can see I've taken this account and I've jammed it pretty heavy. Like I have $676,000 worth of securities against my $700,000 net lick. I also have 6,400 in bill, and I've got some cash sitting there on the side. I mean, I should have taken a snap of last week. I literally had like $1,200 worth of cash. It was so stuffed. How? Why? It goes back to what I was saying a few minutes ago with portfolio margin or even Reg T. You have the ability to trade things that are not futures with the buying power that's thrown off of the T-bills and the T-bill ETF. When you get into, so I hope that makes sense. So there's a huge advantage to not trade futures because you can jam your account with a humongous amount of T-bills and T-bill ETF and use the humongous amount of buying power to run your trades and still have tons of buying power left. No risk of a margin interest, no risk of anything. If the account blows up, the market blows up, I mean, and the market SPY goes way down to these levels, I have to sell T-bills to pay for the tranches I'm getting exercised on as the market goes down. And I'll end up owning it down there. Am I down money? No. If the market goes down to 340 or 3,400 on the S&P, but 340 on SPY, I'm just going to get put some 100 shares of SPY at 340. I just, quote unquote, have to have enough money to pay for it. That's it. It's very cut and dry, relatively simple. Okay, does that make sense to everyone? I see I have some questions. Let me look at those real quick. Yeah, in an IRA, no buying power retention. You simply use your cash. I'll show you that in that account I just showed you in a second. When you participate in an auction at TDA, for example, 10,000, will the cash be held on until assigned and then reduce the maintenance and give you 99% buying power? How long would my account be negative 10,000 cash? All right. It's not enough info for me to make a complete answer on, but the minute you buy the T-bill for 10,000, they're going to give you $9,900 worth of buying power relief. That relief can be used as I'm showing you right here in this account. No futures, just SPY, SPX, XLU, NVIDIA, Microsoft, Apple, whatever you want to trade, DIA, QQQ, whatever, NDX, the index itself, all that can be traded with your $9,900 worth of buying power. So I hope that is answering that question. Now, any reason not to buy CD versus T-bill? No, that's a terrific question. And you kind of answered it. With a CD, you do not get the buying power relief that you do off the T-bill. I don't know what buying power relief you get off of a CD. Interesting that I haven't found that out, but the buying power relief off of treasuries is so monstrous at 99%. And because the treasury itself is typically paying more than a CD does at this current time in the marketplace, I see no reason to deal with CDs at all. But you get tremendous more buying power relief doing a T-bill or a treasury note. All right, let's see what else we have here. CDs aren't marginable. Okay, thanks, Raj. I should have scanned down further. You answered it. I appreciate that. How do you buy T-bills on IBKR? You know what? You're going to have to call your broker, IBKR, and ask, or find one of your compadres that uses IBKR, because I'm not familiar with the platform. I have conferenced with people. They show me their platform. They show me the T-bill section. It's a big, long list of T-bills with the bid and ask price there. It's very user-friendly if you're IBKR platform knowledgeable, which I am not. Okay, any other questions related to buying power and a non-futures trading account? Obviously, you're going to have better buying power relief in a portfolio margin account than you do in a Reg T account. In a Reg T account, to sell a SPY put, you need thousands of dollars worth of margin. In a portfolio margin account, I'm doing it, and it's charging me like, I don't know, I bring in $450 or so worth of premium, and it charges me like $600 or $800 in margin. It's almost a joke. It's so low. So that's the situation of a non-futures account. All right. let's dig into the really challenging part, which is how do I handle a futures account? Because everyone here that's listening to this, with the exception of a couple of people, because I'm running very low futures now, I'm actually transitioning into SPX, so I don't have all the futures problems, etc. I am reopening the Ameritrade account. I am setting up as a portfolio margin account as well as a futures account, which does distort your metrics. If you're tracking your metrics, which I do, your buying power, percent, your delta, your theta, etc., your buying power effect is greatly distorted when you mix all these accounts together. So that's when it's very handy to know what you're trading, how often you're trading it, and what your buying power needs are specifically at any given moment. Igor, I don't know if you're a scheduled trader. I know Tom is a scheduled trader, except for his spec trades. I have become a scheduled trader for the most part, in that I build out a campaign like my SPY put campaign. I sell one SPY put every week for every 100,000 I have in the account. That's my plan. So it takes me weeks to build out a full campaign. So I'm pricing my strikes all over. I'm bringing in different premiums all over. And hopefully, with any luck, by the time I'm approaching a full book, 6 or so weeks from now, if all's going well, some of those first ones are starting to come off. And it can just be a rolling campaign, which is ultimately what we all want. We want the old ones coming off, hitting their profit targets or stops if that's the unfortunate case, freeing up space for new trades. I could go into more detail on how I'm structuring my SPY campaign. Anyone who's interested, go into the fixed income room. I've posted ad nauseum in there. Happy to talk about it some more. But I don't want to get into that too long. I'm already taking up tons of time here. So I do it very low notionally. I do not lever my account a lot. And again, I've got that all explained there. I do have leverage in some accounts, and I will be building it up in others. In this giant, what I call my giant account at Schwab that you've gotten repeated glances at, I'm only selling, I'm going to do it. I said I wouldn't, I'm doing it anyway. I'm only selling enough SPY puts up to the notional value of the account. So I'm not going to sell any more SPY puts than I can pay for with this. So I take the 700,000, for instance, and divide it by roughly my average strike of these. Let's just call it 335 for the hell of it. So that's $33,500. 335 times 100. There's 100 shares of notional SPY in there if I get put. So it's 33.5. So my average tranche has a notional value of 33,500. So I'm going to divide that by 33,500. I can have 21 puts in this account sold and be right at my notional value. My plan right now for this account, this is fresh money. Most of this has come to me in the last 3 or 4 months as I've sold some properties off. I'm not looking at going crazy with it right now. I'm looking at running it very conservatively because I was only earning 6.5 to 7% on it in the real estate. That's all I have to earn, and I don't even have to earn that, but I want to. I've been running that since April under that structure in a different account at Tasty, by the way. And I'm pretty happy with the way it's working. So my plan there, again, is just to run a notional book. So some crazy black swan event happens out there. I'm going to put a whole bunch of SPY. I'm going to have to sell a whole bunch of T-bills to do it. And if the price doesn't drop too far below all these strikes, I won't be really even losing much money. Okay, hope that makes sense. When it comes to futures, we need separate cash for our futures. So, and this is where you guys get more knowledgeable than I am. So if I'm saying something that you don't agree with, raise your hand, chime in, whatever. But futures need their own cash. They need their own cash for the initial purchase or sale of an option, purchase or sale of a futures contract or an option. And then it needs some margin, cash margin sweep money. So this account is an IRA. I've got 50,000. Oh, no, I'm sorry. It's not an IRA. I apologize. I do have an IRA here, and I could show it to you. I'll do that in a minute. And in this section, so under monitor, it gives you your positions. I have only this T-bill thing. Everyone needs to look in their account statement section at Thinkorswim, and it will show you your cash and sweep, which is the same more or less number as this. See, they're the same. And then you have a futures cash balance. You may not have this on your platform. If you don't, call Thinkorswim and say, hey, I need my futures cash balance added. They're going to click some buttons and they'll show you this. Then you'll be able to see how much cash is in your futures account being segregated already. Then when you do a trade, like let's say you sell let's say you do a 1-1X or you sell a naked something or other, you're bringing in premium and it costs buying power, it costs cash, you need margin to do it. That money will come out of cash and sweep and it will go into the futures account. Ameritrade is self-clearing, but it's a separate account anyway under the surface. So we have this big TD Ameritrade umbrella, and under that umbrella is your stock and equity, like stock and option trades of all kinds, et cetera, and your futures, all that stuff. And you have these two little piles of cash. So when you do a trade that needs money, it's going to pull it out of your cash and sweep. You need to have enough money in your cash and sweep. If you're about to do a trade and it's $12,000 a margin, I don't have enough. I need to sell something to make that $12,000 because that's what it's going to need for the initial margin. And then I need at least a couple grand, and we should all know more or less what kind of wiggle we have on each futures position that we're in for margin expansion purposes. So you need a little extra excess there. If I do a $12,000 trade with $8,800 in cash, I'm going to generate a $4,200 margin loan until I sell something. And 2 days later, when it settles, that cash will slowly over 2 days filter in and wipe out that deficit and stop the margin interest I've been accumulating. This is where it gets very tricky for you guys that are trading 50, 60+% all futures. I'm not an expert in that area. That is where my suggestion on how do you tactically do this? Tactical, not practical, but tactical. You do it by looking at your account, knowing your positions, having some idea of how much cash you need and how much cash is typically sitting there. At Ameritrade, it's fairly easy to look at. You look right here and you look right here. This is always going to be positive unless you don't have enough cash to make it positive. If you do, this will be positive and that will be positive. No margin interest at all. In that case, like I have 50,000 in here, of which 41,000 and change is in this bill ETF. Okay, I have 450 shares at 91.55. It's something like 41,000 something, which makes sense because 50 minus 41,000 is 8,800. So that kind of works out mathematically. You need the cash to do the futures trade. You don't need the cash to do the equity index or option equity or index option trade because it comes out of your option buying power. Mine is negative because my check has not cleared yet from when they deposited it last Friday. So this number tomorrow will be a positive number. In fact, I'll post it in the fixed income room tomorrow and you all can look at it and see how that works. So this is funds available for trading. I have a negative option buying power right now because I've got most of the money jammed up in bill. I've got 8,800 in cash and it hasn't freed up the rest fully for me to use. All right, I hope that kind of makes sense. So how do you do this? You look at your account and you're like, I'm at 50% buying power. I have 50% of my account in cash. I have a $100,000 account. 50 is being used for buying power. 50% or 50,000 is in cash, quote, just sitting there for margin expansion purposes, unquote. That's the money you can play with. That's the money we've been talking about for the last hour and a half. Can you use all 50 of it? No, you cannot. Because if you do, and your margin and your positions go against you just a little bit overnight or later today, you're going to be using more than 50% for margin purposes. And you've already used 50% for your T-bill or T-bill ETF purchase. Not good. You've created a margin interest situation. So the conservative way for me to generally throw information out there, because everyone's account is different. Some people are futures only. Some people are futures and portfolio margin. Some people are futures and Reg T. Some people are futures and no Reg T because it's in an IRA account. There's all kinds of little variances. Then you have Ameritrade doing it one way, Schwab doing it another, Tasty doing it another, and IBKR doing it another. Doing it meaning charging or allowing different rates of freed up margin depending on what type of account you're in. So I like starting small, and small means 10%. So if you're in a $100,000 account, buy $10,000 worth of bill or SGov. I'm not endorsing bill. I've just been using bill a long time. A lot of people have talked about SGov, SGOV, and some other T-bill ETFs. There's a ton of them out there. BIL is a 1 to 3 month. That's all they hold in the portfolio is 1 to 3 month. SGov is 0 to 3 months. So they're very similar, but slightly different. You can buy that. It has different buying power relief in it. You need to buy it. Let it settle in your account for T+2. So if you buy it today, I think like Bruce, I believe, bought some earlier. Bruce, you bought some today. If it was at auction, it's going to settle out next week and you'll see the effect on your account. If you actually bought in the secondary market, which I don't think you did, but if you did, it's going to settle out in a day. Those are T+1 typically. So it's going to settle out. You'll see what the effect is. You have a $100,000 account. You have 50,000 in cash and sweep. So it looks. You're looking at your account statement. You're seeing what your cash balance is in both your cash and sweep and your futures. And you can kind of get an idea of what did that $10,000 or 10% of my net lick do to my overall dynamic, my overall money situation here. Oh, hello, account number. Another treat for everyone. So that's there, and then let it settle. And if it looks like you still have a boatload of cash and sweep, buy another 5 or 10% and let it settle for 2 days. Please do not test. That's how you test the edge. You test the edge of your maximum allocation by slowly edging up to it. Because the alternative is, okay, I got 50,000 in cash, 50,000 in margin. How much of that 50,000 in cash can I use? I already said you can't do 50. Maybe you can do 40. If you put 40 in, leaving 10,000 for margin wiggles, it's possible because all this stuff is T+1 or T+2, and it's all operating underneath the surface for settlement. It's possible you did a trade 2 days ago or yesterday or even this morning, this is distorting your numbers, and you're not going to get a clear settled picture of that until 2 days from now. So if you're very active, like many of you are, your accounts may never actually settle. You may never find a number that is safe by waiting and looking. So edge in slowly, go 10%. And then if it's a ton of looking remaining cash and buying power, do another 10% and wait 2 days. Be patient. Walk up to the warm fire slowly. Don't go put your hands right in it because that's when you're going to get your fingertips burned. We do not want to do that. And again, please, I want to reiterate again, I have seen people that not by fault, just they're not grasping the concept fully. They're looking at the buying power effect of what the T-bill or T-bill ETF is doing, and they're over analyzing they're misunderstanding the amount of available cash there actually is to deploy into these things. So we want to maximize, but we don't want to over maximize and create a negative situation and a headache for ourselves. We want to allocate slowly so that we slowly chew up our buying power and our cash, and we can watch it happen. And then we're learning as we do that, so we get a pretty good idea of how it all works. Okay. Raj, yes, in a $100,000 account, you can definitely do 20% in bill or gov, subject to what I just said. If you're sitting there at 50 or 55% buying power and you do a bunch of trades every day, every day, every day, I've seen people that allocated 10% and it was too much. They ended up getting a margin charge. That's where my lack of ability, or that's where my ability stops, because I don't have that deep margin background where I can go in and specifically analyze all this stuff, which is some heavy math. And anyone who's called your portfolio margin department or your any other department at your brokerage company you've asked, they don't always get it. The people in the portfolio margin are great. I don't want to diss them too much. But if you're just asking the regular Ameritrade or the regular Schwab guy, they'll get it right, or girl, excuse me, I don't want to be chauvinistic. They'll get it right a lot of the time, but a lot of the time they don't. I've talked to different people at Tasty, and I can promise you most of them are not getting the big picture. So you have to be careful. We all have to be responsible for our own allocation into this new asset class so that we can dial in the proper allocation for maximum return. When you do that, you're tremendously rewarded. Let's take Raj's example. Let's say Raj is at 40% buying power. Raj has 60,000 in cash just sitting there. He's feeling warm and fuzzy. He's got all that buying power, all that cash sitting there for margin expansion, hoping to never use it. Great. You put your 20,000 in and you see, okay, that did use up pretty much all of it, and that's your allocation. Well, 20,000 at 5% is $1,000 a year. So you're earning $1,000 a year just by figuring this stuff out. And that's your bonus money. It's 80 or 90, 80 something dollars a month, $85 a month. Is it a lot? No, but it's 20% of his 100,000. It's $85 more that month and each month than he was earning before, and can earn literally for the rest of Raj's life on that 20,000. So you can earn $1,000 a year this year, every year for the next 10, 20, 30, 40, however many years Raj is alive. Now, that's great. In my account where you just saw I had 700,000 and I have 600 and I actually have 700,000 face value of T-bills, but some of them are discounts because they're all bought at discount. It's $678,000 worth of current value. I'm earning over a 5% average on that big chunk of 700. So I'm earning an average of $35,000 plus because I'm actually earning more than 5% on average. I'm probably at about 5.2 on average. So I'm earning, we'll call it 5% for easy math purposes. 700,000 at 5% is 35,000. So I'm earning $35,000 on that account, almost 3,000 a month before I get out of bed in the morning. I don't have to do one click. I don't have to do a damn thing. That's pretty nice. I'm a conservative trader. In that account, I'm trading very conservatively with basically no leverage because I'm only selling my SPY puts up to the notional value of the account at this time. Talk to me in 6 months, it'll be more because it's more in my other account where I'm bumping the risk up there. It's a smaller account. I run prototype stuff and expand slowly in smaller accounts. And as I do it over months and maybe 6 months or more, and I get comfortable with it, I expand that strategy or concept to other portfolios. This one, as I mentioned, is fresh money. It's going to be super conservative. It's chunky in T-bills with a little bill ETF, T-bill ETF. And I'm running the SPY puts. What am I going to make on the SPY Leap campaign? I don't know. Ask Igor, ask yourselves, ask Tom King, who's the promoter of that. I'm expecting in a bad market like 2022, where we draw down, we have a grind down, like almost a constant grind down. I'm exiting those at 30%, but I have no stop on those because my stop is assignment because I have the money to get assigned, and I don't mind owning a boatload of SPY if it goes down 25 or 27%. And I'm not just saying that now, I'm saying it even if it happens, for better or worse, because we don't know what will cause the market to go down to that level, and maybe it's going to go down way further. We don't know, but that's my own risk tolerance. That's my own acceptance of risk. So each of us has our own risk tolerance level, etc. All right, I kind of got on a rabbit hole there. Questions?
I think I have a question, and this is probably more about leverage than anything else. So, you brought up an example of a $100,000 account. You're using 40% of the available balance, so that leaves you with $60,000 of free cash, right? Or your buying power is 60,000. So let's say you went ahead and you bought $30,000 worth of T-bills.
Okay.
Is your buying power available is now 30,
Yes.
or is it still 60?
It is available. So in that example, Igor, you have your 30,000 remaining in cash. So that's definitely plenty of buying power for your futures activity, one would think. The other 30,000 is being used in the T-bill, but you're getting 99% margin relief. So that in your case, I know you trade SPX and I know you trade SPY puts. I don't know your futures trading, but I know you trade those. Those aren't using cash. They're using cash if you have cash sitting there. But if they're not. They're using your margin that's being thrown off of these T-bills and the T-bill ETF, if that's there. If you don't have those there, it's using the buying power thrown off by the cash itself. That's what it's been doing all along. If you have a pile of cash sitting there and you're doing all your SPX and SPY puts, blah, 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 it's pulling the buying power off your cash pile. The cash pile is still probably pretty much looking like it's sitting there. And that's how I can allocate so much in this Schwab account. I don't need the cash. I just need the buying power. So in your $100,000 example, 40's in margin, being used for margin, 30 sitting there in cash, and 30's now in a T-bill. You have 30,000 in cash to handle any futures wiggle you may have. And you have 30,000 in buying power that you can use to sell your SPY and your SPX stuff, your options to bring in your premium. And yes, that should work really, really well.
So would your account still show buying power available 60,000?
It would show buying power of 30,000 for the 30,000 in cash, 30,000 minus 1%.
Right, 99%
back for the T-bill. So you're just under 60,000 of buying power, of which all 60 can be used for index and equity options, but only 30,000 of which can be used for your futures trading and futures margin needs.
So that leads me to the next question. Under what scenario, and scenario as in market going down, at what point will you put yourself in a position where you're forced or squeezed to liquidate some of these treasuries in order to, right? So if your buying power can go negative, that's when you get a margin call in the PM account. So what happens if the market starts to fall, volatility starts to increase, you're holding a bunch of naked, let's say, puts that will expand in value, and your broker will require you to put up more money if you will run out of all of your available buying power. So will you run out of available buying power holding treasuries versus just having buying powers and cash available, no treasuries? In other words, do treasuries will holding T-bills will put you in a position to having to liquidate or raise more money faster than if you had no treasuries at all?
If you're trading futures, yes.
No futures. We're just talking about index and equity options.
No, you will not. No. Again, I'm doing all these options, and when I do a trade, it lowers my margin excess and it puts the cash in the account. So my cash balance grows and my available margin decreases.
Got it.
That's on index and equity options. If you're not futures, it's way easier if you're not futures. It's all cut and dry, and there's no sub account going on. There's none of this stuff. It's much more cut and dry and understandable. It's when you add, and I'm not dissing futures. I do futures. I've opened this account you're looking at right now, and I'm going to do futures here. I'm opening a separate dedicated account to futures only. So I'm peeling that off, and I'll be taking what's considered more normal type risk for you guys, although I'll be under you guys levels because, most of you are heavier participants than I want to be as far as leverage. So no futures, no worries per se. When will you get in trouble? In my example, I almost can't get in trouble because SPY can go down to 440 before I'm in trouble. Now, believe me, while the market's heading in that direction, a grind down or a plunge, my margin use of excess funds is being sucked up as that happens. So because I am not selling more than the notional value of the account at this time, the worst that happens to me is the price goes down to those strikes and even below. I get assigned at all those strikes and I start losing money. So an asteroid hits off the Atlantic coast tonight. The market opens up at 3,000 tomorrow. It'd take a couple days to get there because of circuit breakers, but it would get there if it stayed open long enough. And, if we're sitting there at 3,000 and SPY's at 300, I'm going to get assigned a whole bunch of SPY between 320 and 340, and I'm going to be underwater between 20 and 40,000 per tranche. So, yeah, I could use up all my margin excess and start losing money, but I'm losing money. I have no leverage, so there's not going to be any exponential rise in my margin and cash needs. Now, if I went 1.2 times notional, say I sold 24 SPY puts instead of 20 or 21 or whatever, and I'm actually above the notional value of my account and the market blows up in that direction, I am going to run out of buying power before it gets to those strikes because I'm using some leverage.
Mm-hmm.
So in that case, I'm gonna have to be selling T-bills on the way down as my margin excess tanks and approaches zero. So in that regard, I always say, if you wake up one day and it's not even a black swan event, you've just allocated properly, and all of a sudden there's a tremendous spike in volatility in whatever you're trading or many things you're trading, go handle and your negative cash. You got your phone call or whatever email on a margin. You owe margin, or you might even have a margin call in that situation. Go deal with your headache. Whatever your plan says, is it a roll? Is it a cover? Is it a stop loss? Is it whatever it is, buy long? Whatever you do, we each do to control our out of control positions, do first. Then go to your BIL or your T-bill and sell it. Second, those aren't moving a lot. And if all hell's breaking loose, treasuries are generally rallying, going up in price, causing yields to fall. All these things will be edging up in value as everything else is falling because there's a flight to quality, and that's where people fly to when they want quality. That and gold sometime. Bonds and gold. That's typically where flight to quality, flight to safety money runs. So no notional multiple, no need for cash. Barely anyone's doing that. This concept has applied to people like me, older people who are just trying to extract a decent return, more than they can just earn on treasuries or corporates, less risk than if they just put it in SPY and let it run and pull 5 or 7% out a year and hope we don't have a 25% drawdown. Because if we do, and you've pulled 5% out of your account, you're down 30%. Good luck recovering on that. So this is a way for me personally to trade the whole package and generate what I'm thinking is going to be in this conservative account that I've just shown you. What does the SPY campaign throw off? I think in a pathetic year, I should get 2 or 3 turns of 30% on that. I might only get one. If the market ground down the wrong way, I might never hit 30%. So, and if I don't have a stop, I might just end up owning a bunch of SPY at those prices. It's a conscious decision. Ask me for clarification.
I think it makes sense. And if I understand this correctly, in other words, let's say you have a $100,000 account, the very first thing you can do is go ahead and buy $100,000 worth of treasuries, right? T-bills. And that'll give you $99,000 back in relief. So now you're holding 100 grand in T-bills. You have $99,000 available to start doing your campaigns, but you cannot do, let's say in your example, a short SPY campaign in excess of 1x net lick of your account.
Well,
if you wanted to lever up a little more on the short SPYs, then you cannot buy $100,000 worth of T-bills. You could only do $50,000 or something like that.
That's close. That's close to accurate. Actually,
Right.
if you're not, we're still in no futures mode.
Right.
So
No futures.
No futures. You get to use the buying power up to that 99,000 number. So let's say you're at at Thinkorswim and they require 125 for portfolio margin, but 100 minimum, and your accounts trickle down to 100. You do what you just said. You take 99,000 out of 100. You could even take 100,000, put it all in. You get $99,000 worth of relief. You go to sell a SPY put. You're in portfolio margin. They're going to charge you like $800 or $1,000 worth of margin interest. I mean, of margin. That's your buying power getting. For that buying power requirement. Sorry. For that trade. So with those numbers, in theory, you could sell 99 SPY puts with that $99,000.
Well,
right. As well as I do, as you get closer to that full leverage, they're going to change their little calculation and they're going to say, oh, they'll start tightening that to where you won't get that same margin. I don't think when you start approaching near 100, 70, 80, when you start going huge multiples over your notional value, they're going to raise the amount of.
So I know what they do because I had a conversation with someone at TD PM accounts. They look at your net lick and they cannot allow you. They don't allow you to take on more. They don't allow you to take on more risk than your net liquid value of your account plus 5 million. And to get that number, you look at your all of your positions in your account. You move your price slice down. I think it's hang on, I'll tell you what it is. So you move your price slice down 20% and you bump IV up 17%. I said, where do you get 17? He says, this is what that number is. And that's pretty accurate. Whatever they're using on their end, he didn't want to go into details, but so you take vol up 17% and you take your price slice down 20%, whatever that number, the P&L on the day shows. Let's say you have $1 million account. So now that price slice at minus 20% and volatility up 17% cannot exceed 6 million, which is 1 million your net liquid plus 5 million. In other words, Schwab, since they took over TD or Thinkorswim, that whole company, in other words, they are willing to hold the bag up to $5 million. So if you go upside down, you go negative equity, right? You wiped out, and you're left with a $5 million balance. They're willing to eat that. And that 5 million, so I said, is that 5 million proportion to something? He said, no, it's 5 million. So if you have a $50 million account, your max risk you could take on is 55 million. If you have a $1 million account, your max risk is 6. If you have a $10 million account, your max risk is 15. So that 5 million excess of what your net lick is how much they're willing to allow you. So in your example, if you take 99 short SPY puts, I don't think it's going to work because you're going to go over that number. Again, you got to, model the trade, take the price slice down 20%, bump your vol, and then you will see how much actual risk you're taking on. I don't think 99 puts will fit, but you have the right idea.
Yeah, it won't. And the more leverage you take, which is the more positions you take on based on your net lick, the more extreme it is. And I hear what you're saying. Super interesting. When I talked to them, they said they look at plus or minus 15% in a portfolio.
That's standard, right? Okay. Standard PM looks at plus minus 15. But when you start to get concentrated in any one position, they want to see
they change the rules.
What your actual, not just the price. They don't just stress test for price movement. They also look at volatility shock, and the volatility shock is they bump IV 17%, and the price slice goes down 20%, whatever that number under P&L today column is, cannot exceed your net liquid by 5 million. Anything above that, they'll put your account into closing transactions only until you get back within that net liquid plus 5 million zone.
All right. So that's great info. It's some very large numbers, but it's great info. And again, I want to emphasize, don't spend your cash more than once. If you got that $100,000 account, you can't buy more than $100,000 worth of these fixed income securities. And even then, you got to watch the buying power, the margin excess that it's throwing off that you can use for equity and index options. Futures are their own separate critter with their own separate cash needs. So, Igor, we're at 2 hours, we're at an hour on the second one. I can continue. I don't know. I mean, like, there's a lot more to be covered.
I think, yeah, we can talk about this. There's so many more things to talk about. I think information that you shared today is definitely great. There's definitely a lot of information, a lot to think about. I think that maybe it's easier because I see that it's after, right, it's 4:30, so I don't know what people's plans are, but maybe doing like an hour and a half sessions. But if you have 6 hours worth of material, we could just break it down into like 4 meetings and space them out. So this way, you can deliver a decent amount of information and save some for the next meeting where, people will be able to join us, because I think if we go any longer, there may be just the 2 of us here. And I would rather have people come live and be able to ask questions. And that's my thought.
I'm fine with that. And as I mentioned to you, Igor, and in the chat room, I do plan on, this week is crazy for me. Like this afternoon is like the only time I have really all week. Starting next week, much more normal. And the week after that, even more so. I really would like to have every week some type of little pop-up session where we can do one of these. People can either write in and say, hey, let's cover this, or it can just be a spur of the moment conversation where if people want to, like, look at my account, what do you think, kind of thing. I'm fine with whatever helps people disseminate this information. Again, for most people, this is an add-on. It's an add-on on top of everything you've been doing. But if you're in a situation like I'm in, where I'm not looking at making a 20 to 30 or 40% potential return. I really want to make a better than fixed income return and have less than normal market risk to do it. So I don't want to take my whole 700 and put it in SPY and write covered calls on it or hope the market doesn't blow up and I just pull. I don't want to do that. I'm using the SPX complex and its dynamic like skew to work for my advantage so I can make a stack. I call it a stack. Like I have a stack of SPY leaps, that's one stack. My T-bills are another stack. If I start doing SPX 111, 112s, which I have started doing in my Tasty account, which I didn't have a chance to get into today, then it's another stack. And I add those together, and I want to be able to understand what is risk, what is leverage, and what is not. So like one of Tom's favorite things is only hedge what you need hedging. Well, what we need hedging might be different for you versus me versus him versus, I understand the concept and I understand the logic of what he's presenting, but different portfolios and risk tolerances have different levels of what they may or may not need hedging. I want to run my portfolio like this big one that you just saw. It's big for me. I want that thing to run on autopilot. So I really have no worries about it. The worst thing that happens is the market explodes. I get shoved a whole bunch of SPY down 25 or 27%. And unless it's the end of the world, it's probably a good thing. If it's the end of the world, well, it doesn't matter anyway. So that's my somewhat sarcastic comment on that. In my Tasty account, where I'm running the same thing, plus I'm doing 11X in it, I was doing ES 11s and then 2s. I was doing an LT campaign. I'm now running an LT campaign with a similarly structured SPX. So instead of like a normal 112 has a $50 wide put debit spread, and then the 2 nakeds for whatever premium. In an LT, it's typically $1,000 or $1,200 or $1,300, whatever you want it to be. I'm actually setting SPX up to be a 25 wide, which is notionally the same amount as a 50 wide ES. And then I'm selling one naked put. So I'm doing a 111 there in SPX with not quite the strikes of two nakeds way down on an ES trade, but they're pretty far down on a one single one. And I'm generating the same about $1,100 per tranche to do it. So I'm running an LT campaign, but I'm doing it with SPX. So I don't have all these cash issues to wonder and worry about. But in that structure, if you look at my whole campaign there, T-bill, SPY campaign, little bit of bill, and some 11X, the only leverage I have is the 11X. So if I come in and the market's exploding, I know exactly what I need to go pay attention to and worry about. I'm not like, oh my God, deer in the headlights, it's all blowing up. What do I do? I know what's going on. My SPY lead campaign, bring it. I'll take it down 27%. It's all the other added trades that result in leverage for my account. So these are just like everything we're saying will become much more familiar with people over time. Again, I'll close with saying start slow, do a 5 or 10% allocation into BIL, SGov, or a T-bill, and then let it sit and let it work and see what it looks like and learn. Come to me and ask questions. I'm right there. I'm here almost every day. Come to me and ask questions. I'm happy to help people. I get tremendous pleasure out of helping people find this, what I call free money. And then them like, holy, I can't tell you how many of your subscribers, probably 15 of them already. I've worked with people who are now making $600 to $3,000 a month, more than they were before our conversation. Think about how incredible that is for not only them, but like I'm the one that enabled that. So I want to keep enabling as many people as I can to find their little free bucket of money without burning their fingertips with all the margin interest issues that may arise if it's not done correctly or done too quickly.
And I think that this is definitely something that everyone can use, especially now. Again, a couple of years ago when rates were at 0, this didn't matter as much. When rates are at 5%, and if you can do something to add income to your portfolio without taking, I guess, a ton of risk, right? You're using the leverage because you get the relief from the T-bills. So I think that there's definitely a place and a time for something like this. My takeaway from this is that, don't go all in all at once, because you really don't know how it's going to affect your available cash that you may have, how this is going to interfere with some of the other positions you may be holding. Ease into it. And one more thing I wanted to add before I forget. So on the Discord server, I have created a section for strategy discussion. They're marked with little yellow icons. And I added a fixed income strategy discussion. It's a forum board, meaning you can go on, anyone, right? Anyone could go on and create a new post, right? So, and this is not to take away from any discussion that may be taking place in the chat, right? But in the chat, if there's 5 people having a conversation at the same time, things could be a little difficult to follow. And especially if you wanted to come back and find something, and then again, you have 5 different people all posting at the same time, things get really busy. Using these discussion forums, right? For example, I just posted as an example, and this is a question that I have for the group, right? How do you buy T-bills with Tastytrade? We just saw how to buy it using the TD's website. I don't know if I missed maybe, but my question is, how do you buy T-bills with Tastytrade? I'm sure I am not the only one with the same question. Right. This question will come up time and time again. So now for somebody who's going to join us 6 months from now, he's going to hear about all of this information. And the first thing that comes to their mind is, how do you buy it with Tastytrade? Well, they don't have to go. And of course, they're welcome to ask in the group, and someone will refer them to this specific post that I just created. It just makes retention of information and makes things a lot more organized for us to use in the future. So I do encourage everyone to don't be afraid. There's no such thing as stupid questions. Go in there, post a question. People with knowledge will go and reply. Everyone is able to reply, and it'll definitely keep all of these different topics a lot more organized than if we were just to put everything in the chat and then try to find something 6 months from now. I think it would be next to impossible.
And I appreciate, and look, I have your Discord pulled up with the strategy discussion section highlighted and your fixed income trading room that you just started, or I don't know if you call it a room or whatever, thread.
Yep, that's exactly what it is.
I have that pulled up, and that's handy. I'll try to do that.
So now if you click on it and you wanted to reply to it, and anyone should be able to do that, right? You see it says send message in, and then everyone is able to get an input in. So if you have anything to add, you or anybody else, they can do that. And then at some point, right, when and then it'll stay there in the under fixed income discussion. And then, for example, if let's say if somebody wanted to just follow along the conversation, they have nothing to input. This is something that comes up sometimes too. So now if you click on that post that I just created, you see where it says follow. You click on follow, and now anytime somebody adds to this post, you will get a notification on the left, right? See how it just came up under the fixed income trading section. We have this post. It's going to go away tomorrow. In 24 hours, if there's no new activity on this post, it'll go away. But as soon as somebody adds something new to it, it'll come back for the next 24 hours, and you will see that there's new information there. You can go and you can read it. I think it's a very powerful feature that we should use more of. I don't want to discourage people from posting in the chat. Chat is great for chit chat. But if you want to talk about something, or if you're looking for information that's just more than, a small talk, I think using these forum boards is very powerful. And I think that we can definitely get a lot more out of it.
Okay, great. And I'll try to migrate some of what I've been doing here in the fixed income room. I have a ton of stuff pinned up here. I mean, I've used my max. Now I'm breaking. I got to remove something to add more. I think it allows me to do 50 things or something. So I've got a ton there. I also have some threads that I started, kind of trying to do what you're suggesting.
Right. So this will sort of not just replace, but it's very similar to threads, but they call them topics. So this is a forum board, and that specific section is for anything related to fixed income trading strategies. Like, for example, somebody says, guys, how do you ladder, 8-week T-bills? Well, you can ask in the chat and get an answer, and then it'll just, over time kind of get lost, if that makes sense. Or if somebody was to post that here on this forum, right? Same way I just asked this question, how do you buy T-bills with Tastytrade? Someone could say, start a new post that says, how do you ladder 8-week T-bills? And then when somebody tries to do the same or is looking for this information 6 months from now, they know that they can go into this fixed income trading part of this discussion board, and every single topic has its own thread, so to speak, and they're all on the same page. They're very easy to find and navigate. So that's why I added this feature.
Great.
Hey, Igor.
Yes, sir.
Hey, great session. Also, thanks to Ed as well. Thanks to you. Great session here. Quick question for you, because I know you do SPX 112. So my question was really around, does it make sense to do SPX 112 with Bill versus the ES 112 with Bill? So because I know Tom's stuff is all around ES, CL, and things like that, right? All the future stuff. So, but looks like almost the cash management part, from what Ed is saying, it makes it a lot better with SPX. I just wanted to hear your thoughts because I know you guys are the experts, you and Ed are. So
You
just thought
know,
I'll ask the question,
there
chatting it up.
from what I understand, um, there are two parts to this, right? So doing SPX will require a lot more buying power. So if you have the account size to do SPX, now remember, you don't have to only do SPX. There's also XSP, which people say it's not as liquid, but it's liquid enough to, you know, so it's 1/10 the size of SPX. So I would probably, if I wanted to get away from doing futures, because you don't get the same leverage with using index or equity options. So if I wanted to get away from doing futures or options on futures, I would look at SPX. If SPX is too big a contract, I would look at XSP and do T-bill at the same time. Otherwise, you're kind of forced to go with the futures, ES, MES, but then you can't really do T-bills, or you can, but you don't get the same leverage because futures need its own cash. So you have to stay on top of cash management a lot more with the future. So you have to kind of pick and choose which way you want to go. Do you want to go on the autopilot? Then you have to go with SPX or XSP or SPY. If you are really on top of your platform and you know how to read the balance pages and understand how much cash you actually have, then you can probably use futures together with T-bills. I don't think there's a right and wrong answer. It's what works best for you in your circumstances.
Makes sense. Thank you. Thank you.
Yeah, and I agree with that. And look, there's a lot of pluses. Like futures, you can trade 24 hours a day from Sunday night until Friday afternoon,
Correct.
except for that little brief break they take every afternoon for whatever, from 4 to 5 p.m. Central, whatever time it is. So that's great. It's great if you're not in the United States. It's great if you need that 24-hour ability. It's great if you want the flexibility of leaving an order in overnight and maybe having it fill. All that's terrific. The negative part is like this cash management part, which may be completely this was meaningless to everyone before this information was presented. Now that this is presented, it kind of gives a different complexity to balancing what's best for me. Everyone's what's best for me kind of depends on how all this speaks to you. And you can't finish this session and say, oh, this speaks to me, I'm going to do it this way. It's an evolutionary, I mean, it may, like whoever this person is, I didn't catch your name, I'm sorry. But
yeah, sorry, my name is Raj.
Raj, okay, Raj. So you may be, because you've asked some questions, you may get all this and you're like, holy cow, I'm out of here on futures. I'm doing all SPX. I like this. I like the way it sounds. It's going to be a lot easier and I want to take advantage of the cash management part. Great. But if you're trading ES and 4 or 5 or 7 or even 2 or 1 other commodity and you want to keep doing that, you got to keep trading the futures and you might as well just stick with what you're doing and just manage your cash accordingly, which means manage it a lot more conservatively, because there's a lot more stuff going on under the surface with all that money moving around every day. T+2 from Tasty from Apex to StoneCo, their futures clearing farm, back to Apex, back to your platform on Tasty. All kind of little shuffling along going on there. Even at Ameritrade, where we just looked and we saw you have these two different these two different amounts like I have here. You can see that, but if I did some trades today, this number is not, it's going to be different tomorrow morning. So it depends on what your mission is, what you're trading, what you want to trade, and kind of like what speaks to you. Because I can structure my 1-1X trade, like here's one. Here's one I just did, okay? So I did the 25 wide, like I mentioned, and then I sold one 3,600 put for 1,650. So I took in 1,650 and I spent whatever that is, $5, $4.90, something like that. So I took in about 1,150 net, and it's a 1-1-1, and it's bringing in 1,150. So it's kind of got the premium of an LT. It's got
what is the buying power that you sucked up on that one?
I'm sorry.
What's the buying power that it used up?
Let's see what it is to exit. I think it's like 8 grand. So it's about 8 grand. It cost me a little more of that to get into it because initial margin and the position's gone my way a little bit. So I think it was maybe 8,800 to start. It's more money, but it's less cash. So if I'm sitting here with a boatload of option buying power, I don't need any cash to do this trade. So I don't care if I'm spending 8,800 versus 5,500 or 6 grand to do a 1-1, whatever it is. I'm also doing a single naked. Well, I'm exiting, but that's a naked. I'm also doing a single naked versus 2. I'm not advocating this. I'm just saying after being here in this Discord and watching and learning and doing what I've been doing, this was my big aha the last few weeks. Like, aha, I don't trade other futures right now in this account. I can just switch to SPX and put on a notionally similar trade. I still have a $2,500 put debit spread. I still have about $1,100 of net, $1,100 to $1,200 of net premium coming to me on the whole tranche. It feels and looks and acts very much like an ES 112. Yes, my naked is much higher than 2. This is probably 3,400 on 2 of them. That's okay. It's my choice. That's all right. That's where each of us does it a little differently. So although it's more margin, I have the buying power with my account structure the way it is to do this, and I could care less what the buying power is. All I know is I don't have any cash management needs, so I can stuff more money into my T-bills and T-bill ETF. So that works for me. A lot of people are going to love the allure and the 24-hourness of equity futures, equity options trading and futures trading, and they love their commodities. For all of you, which is probably the majority of people listening and reviewing this, what I've been talking about only applies to you so much, because you're going to want to keep doing your commodities options and futures options probably, because that's what your plan has been set up for. That's what you're doing to target the returns that you're trying to generate. If you're like me and you're just trading ES, you can set this thing up very notionally similar, notionally meaning the same amount of money for similar margin and everything else, and forget the buying, forget the cash. I'm only putting on 3 of these at one time anyway. When it comes time to do numero 4, my rule says this naked on one of them has to be gone. I can't have 4 sets of naked puts on at any one time. I can only have 3. So if I get 90 days in and the market's been acting poorly and I can't take off a naked at 85 or 90 or whatever my magic percent is, because that varies. I know the standard method of operation was let it go to maturity. I've been running it, taking it off at 85 to 90% since last summer. I discovered it on my own. No one told me anything. I just thought of it in my own head and started doing it. And the reason I started doing it is I'd rather take off a $1.50 credit and go put on a fresh $13 credit with the same, not risk, because by the time that credit gets down to $1.50 or $2.50, that expiration is so far out of the money that it's almost risk-free. I'll say almost. But in a black swan event, that little stinker comes back to life to bite you. And so it doesn't work for me in that regard, but it probably works for the vast majority of people. I'm going SPX, and I'm not doing SPX Igor style. Igor might be doing 2 tranches, and Igor might be taking in 20 points net. I'm sorry, Igor, I can't quote exactly what you do because I haven't studied up on it yet, my friend. I know you got your bear trade and you do your others and all your other stuff. So I don't know, but this is where we all have to tweak on all these things to do what we want them to do for us and deliver that in the most pleasant way that they can that speaks to each of us. So the message I hear is minimum notional risk for the return I want to make. Other people could give a crap less what their notional exposure is or what their blow up risk is. They may not even understand their blow up or notional risk, but they know that shooting for 25 or 30 or 35% every year. I'm shooting for my 1.5 or my 2% a month or my 3% a month. Well, you're shooting for 18 to 36%. you're taking added risk versus me who's shooting for 9 or 11 in a similar styled type trade. It
Hey,
just,
Ed, do you mind sharing your 111 trade and the members trade or whatever, however you want to tag it? Leave it up to you and Igor.
yeah, me?
Just for learning purposes, right? I
Yeah,
mean,
absolutely.
it's a good angle to it. I mean, I'm purely only on either do Igor's trade or Tom's trade, right? So I like, quite honestly, I like the ES, but again, for better cash management, I might do this on other accounts, right? So,
There's
so
no rush. Check it
yeah,
out and play with it
yeah.
and see what happens. Look, so under my, I hate to call it my fixed income room, but I'll be a little possessive and call it my fixed income room.
It is yours.
It's my fixed income room until Igor removes me. I do under my threads have my account positioning.
Yeah.
And like this is here. This is this TD trade. This is when I had more of it in ES. You can see these ES positions. I've rolled out of those and I had this Microsoft thing I don't have anymore. This type of thing I'm not doing in this account anymore. I'm gonna do it in that other account you guys saw earlier. So this is the current structure that I got. The only ES I have left is this put debit spread here that is paid for plus a profit from the naked that was there. You see, I had the 3650 nakeds. That's how I label mine. I say what it is and where the nakeds are. Just like here. I like to know where my nakeds are before I get too far in. Okay. So that's sitting there paid for. Now it's paid for, but it's worth 12 or 13 bucks. If this thing doesn't get in the trap, I'm losing 12 or so points on this thing while I wait and watch. So, I was just going to show you what it's worth right now. 1350. So if this thing starts trickling down to 10, which is what I paid for it initially, I may take it off. I may not. This is what an area I don't have a great rule personal. And this is the kind of thing I'd love to discuss in our more frequent to be done conversations. I'm happy sharing all this nitty gritty. I want to hear what you guys are doing. I'm sharing, I'm learning. It's a bit give and take. I love it. Okay. So
Thank
what I typically do with this trade,
you.
I'm running this LT campaign at any given time. Like this is not due for another LT for 26 days. At any time between now and 26 days from now, if the market starts doing something and I want another position, I can't put on another LT on my plan. It's not time yet. But I got this sitting here. I might go sell an ES because this is an ES. I might go sell an ES 3600 strike in something like the 66 day. Or I hate to say it, I diagonalize these things. I might go out 80 or 84 days and have a put debit spread that matures a week or two before my naked position. I know I can feel some of you cringing. That's something I understand. And when I'm campaigning, I know that I often have a lot of put debit spreads that are unattached. And those put debit spreads are protecting the entire portfolio. They're not protecting generally the naked put I'm putting on with the put debit spread. In a pure LT campaign, they are. You take this to expiration or you take this down to whatever you take it down to, 90, 95%, whatever your rule is, it may be expiration, in which case this tranche of put debit spread is protecting that the whole time. But in this case, where this thing's got 54 days to go, and I've been in it, or 66 days to go, and I've been in it for 54 days, I've been out of this naked for like a week and a half already. This thing's just sitting there. I'm waiting for the market to pull back into it. If it doesn't, at some point, I'm going to put some premium under this. It's already paid for, put debit spread. The $500 is paid for, but it's going to decay. So even though it's paid for, I just do not lose the decay part either. So I will permission myself to go in here and lay some naked on underneath and use it to protect, use this to protect that naked.
All right. Thanks, Ed. I got to drop, but thank you so much. Appreciate it.
My pleasure. Thank you. And thank everyone. I really appreciate it. I enjoy this. I hope you guys did too. I know I have a tendency to blab on. It's part me and part compulsion to get out as much as I possibly can because it's a lot of information to shove out the door. So I did not get into the structure of this too much, except after session just now. I did go into a pretty good amount of what I call my larger account. This is a $250,000 account. The other one's 7. The other one's traded more conservatively. This one's more aggressive. This one's kind of like got a full SPY campaign built out. I have one more to do, which is I do every Wednesday. I just removed one that hit a price target today. I was actually at like 29 and not 30%. I took it off because I want to free myself up to do one tomorrow. I didn't do one last week because last week I had 7, which is a full book at 250 times these strikes, if you followed what I was saying earlier. This is not leverage. It is leverage, but in my mind, I understand it's not leverage because I got these T-bills to pay it off if all hell breaks loose. This is the leverage in my account that I have to pay attention to if and when all hell breaks loose. If I even need to pay attention to it, it may be self-managing itself, as you know, some of our favorite people tend to say. This is a largely self-hedging thing, especially once you get into 3 or so tranches and you get maybe a set of put debit spreads or 2. They're sitting there for extra protection. That's a beautiful thing. I love that situation. Early on, when you put your first LT on, and even when you first put your second one on, keep your fingers crossed, because if all hell breaks loose and vol explodes, these put debit spreads are basically doing Zippo for you. You need mature put debit spreads that are closer to maturity, because the closer they are to maturity, the more resilient they are at a price movement. The further away they are, like this 54-day, this thing is not great value to me. It's a value because it's a pretty close put debit spread, and it's actually in the money now, which I'm flirting with. I'm not taking that little profit. I'm up $187 on the put debit spread. I have this here for total account protection. At any time, like I said, I can lay some more nakeds on here. I can sell more SPY puts underneath. I can sell an ES single or even do an ES double and convert it back into a 112. I could add a 112 in addition to this and have 2 put debit spreads for the 2 nakeds. Very flexible. It should all be in your trading plan. All this subjective sounding stuff is all in my permission in my trading plan. The etched in stone is I do a SPY put every week. Every Wednesday I do a SPY put, unless I have 7 on and none of them have reached 30% yet, in which case I skip. And I wait until there's a Wednesday where there is an opening. If tomorrow 2 of these pop off because we have a huge market rally, I can only put 1 on. I can only put 1 on per week per my plan. So some things are very much etched in stone and some things are very subjective, but even the subjective stuff has been addressed in my plan. I hope that kind of speaks to it. So, you know, we'll talk about all this and more in the future. I mean, like, I'm passionate about this stuff. I'm not a genius. I'm not an expert. Many of you listening to this have a much deeper knowledge of options and commodities trading than I do, different types of trades and stuff. I've sold nakeds. I did this 111, 112 stuff for about 1.5 years now. I used to do a ton of ratio spreads and still like them and still look at them. All a 111 is a ratio spread with one of the 2 naked puts stretched further out. So, and all a 112 is a stretched out ratio spread with an extra naked added. You know, like, so all these things are kind of similar, but different. So it's just a matter of what speaks to you and what you want to trade and what you're comfortable with. But I'm not a pro in all that stuff. I have tons of stuff to learn. I look forward to that as well. Again, repetitive. I just look forward to continuing to share all this with you guys. I can't tell you how much fun it is. Like, I talked to one of your people yesterday morning. He's like, check me out. I got my $1,790 in from the bill last month. Does this still look okay? Yeah. Thanks. Like, that guy's making $1,800 a month from now on, as long as rates stay up from where they are. Wow. 22 extra $1,000 plus or minus a couple hundred a year just by understanding this. Now, that's a larger account. I think we put like 600,000 into Bill in his 800 and something $1,000 account. So again, it's going to vary by person. What are you trading? What kind of account you have? How levered are you, etc. But no matter what, even if you have a $10,000 account and you have 5,000 sitting there in cash, you could still take 2,000 and you could still earn an extra $100 a year. All right, that's not much. It may not be worth it, but you're training yourself on how to do it when your account gets bigger or you come into more money. It's a technique that should be carried through your life because it kind of almost can't hurt you unless you way over allocate and generate yourself a big old margin bill, in which case you should be looking, and it's only going to happen one time during 1 month and it'll never happen again because you now understand the rules. Make sense?
It sure does.
Thanks,
And
everybody. Appreciate your patience.
all righty. I think we're going to wrap this up. Definitely a ton of information. This video is going to be available for a replay. A lot of good information. And I look forward to any future presentations, meetings, follow-ups that you are going to do, Ed. I definitely can't thank you enough for taking the time out of your day to share this information with us.
My pleasure.
For me personally, I've never thought about fixed income or how fixed income could potentially provide another stream of revenue. Because if you do have excess cash and it's just sitting doing nothing, either you're earning it or your broker is taking your money and earning it for you.
Bingo.
So might as well it be you. Definitely appreciate your time. Thanks everybody for taking the time to join us. Any future meetings that we may do, we will definitely post on Discord to keep everybody up to speed. And with that being said, everybody enjoy the rest of your day. We will be in touch soon.
Thanks, everyone.